Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, August 28th. Nvidia announced very strong quarterly results yesterday after the bell, but the slowing growth rate encouraged investors to take profit following the results in the after-hours trading. Chinese chip makers, on the other hand, extended their rally, hinting that the chip speculation could be changing hands. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So Nvidia revealed its second quarter results yesterday after the closing bell, and the results were again very impressive. The company made 46.7 billion US dollars in revenue last quarter, in line with expectations, and that without selling any H20 chips to China due to export restrictions. And the profit margin climbed back above the 70% mark, and the company said that it predicts to earn 54 billion US dollars this quarter, still without taking the Chinese sales into account because things there are looking very much complicated right now. Not only that the US government is now willing to take a 15% cut of these Chinese sales of Nvidia, but the Chinese, well, they don't want to buy American chips anymore because they want their companies to buy local chips. Now, it doesn't mean that Nvidia will no longer sell its chips to China. On the contrary, Nvidia CEO Jensen Huang said after the earnings that selling Blackwell chips to China is a real possibility, but the company has actually the luxury today to ignore that opportunity in its forecast due to factors that actually don't depend on them. And listen, 54 billion US dollar is what they expect to make without the Chinese sales. So that would be already a 15% jump in just one quarter to their revenue without China. So the numbers are still gigantic, but they are not as gigantic as the best of the estimates out there, and the company's revenue actually grew by 56% last quarter year over year, but the growth rate, and more importantly the data centers revenue growth rate, actually slowed a little last quarter, which explains perfectly why Nvidia's stock price was sent down by more than 3% in the after-hours trading following the announcement of the results. Even the announcement of a 60 billion US dollar worth of share buyback didn't justify a post-earnings rally in Nvidia. So this is where we are today. The rising worries that the Nvidia's earnings growth rate was slowing, hence that we may be reaching a level of saturation in AI-related technology holdings in the United States, and that there could be a certain correction toward the downside. So the S&P 500 futures are slightly down this morning at the time I'm talking here, after the index hit a fresh all-time high level ahead of Nvidia earnings yesterday, while Nasdaq futures are trading some 0.25% lower at the time of talking this morning. I think that yesterday's optimism in the market, or the lack of major reaction today from the major US indices to Nvidia's results, well, is due to a significant downside pressure that we see in the US 2-year yield that actually incorporates the rising expectation for Fed cuts in the future amid the US government's attacks on the Fed members today. So the US 2-year yield now pays around 3.60% versus around 4% yield before the latest jobs data and the Fed drama. The US 10-year yield is a touch above the 4.20% level, under pressure as well. And the good news is, even the US 30-year yield looks softer this morning, and the latter could eventually help tempering the rising fears of a slowing AI spending after Nvidia's quarterly results. Now note that in China, it is the opposite story unfolding these days. Cambricon, which is a Chinese chip maker, actually announced a 44 times increase to its own revenue compared to last year yesterday. So they went from a $500 million loss to $1 billion profit in just 1 year, as local Chinese technology giants, companies like Alibaba, DeepSeek, ByteDance, and Didi are cited among the company's biggest customers and that they are actually asked to buy local Chinese chips from the Chinese government to decrease China's and the Chinese technology companies' tech dependency on the US. So normal, Cameron gained 7% after the results and is up by 180% since mid-July. But be careful because at the current valuation, Cameron has a PE ratio of 514 versus Nvidia's 52. So it means that if you find Nvidia expensive, well, Cameron is 10 times more expensive when you take the money that they make into account rather than just their stock price. Another publicly traded Chinese chip giant, SMIC, was also up by 8% today, and the company has a PE ratio of 110. But anyway, that is it for the chip story. The speculative bets are now moving toward the Chinese names, and I think that there is opportunity in more established Chinese names in China, like Alibaba, for example, that trades with comparably lower PE ratio, so around 18 for Alibaba, to their US peers. And truly, if the valuation gap between the Chinese and US companies, tech giants, is due to government risks, well, the US government risks have risen enough, in my opinion, to justify a significant convergence between the US and the Chinese peers. Now, speaking of governments, Mexico announced to increase tariffs on China to please Donald Trump, and India is now faced with the tough reality of 50% tariffs on its exports toward the United States because they, well, simply didn't want to stop buying cheap Russian oil on US demand. So the latter will likely put the country's ambitions of becoming the US backyard factory in jeopardy. So the Nifty 50 is again under pressure today, and the latest rally failed to gain momentum. But wait, that's not the end of the story because only 9% of Nifty 50's total revenue comes from the United States, and the US actually wants its companies, like Apple, for example, to bring their production back to the US anyway. So India may have more to lose in giving up its cheap energy from Russia than giving up on its US exports. And furthermore, stimulus from the Reserve Bank of India and the Indian government could eventually help improve appetite in local stocks that do have local focus more than Chinese or US stocks. In Europe, the French political shenanigans continue to sit on the headlines, obviously, now joined by rising political dispute and tensions in Netherlands on Gaza. But note that the Dutch political issue still little market reaction because it's really very political, while the French political dispute concerns the country's rising debt and the fact that the opposition parties there are not letting the PM, Francois Bayrou, elaborate a plan to control the country's widening budget deficit. So that has a direct impact on market pricing. The 10-year yield spread between the German and French government bonds actually rose past 80 basis points. This is the highest level since January, and this gap could eventually widen to 100 basis points according to some out there if the French government collapses along with the hope of seeing the French budget deficit narrow one day. So the widening German-French sovereign yield spread will likely limit the euro's upside potential versus a broadly softer US dollar. So it will pretty much come down to which currency between the euro and the greenback will be less loved by investors due to their rising debt concerns. I think that the US looks more worrying to me today than the euro area countries. Now, today, the US will be revealing its latest GDP update, and tomorrow, we'll see the Fed's favorite gauge of inflation, the core PCE index, land on the market. The way the data will shape the Fed expectations should eventually steal the spotlight now that the Nvidia earnings are behind us, so the economic data will be important for market sentiment and the direction from here. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.